Okay, S&P 500 futures are sliding, currently down about 0.2%.
Hmm.
The Nasdaq 100 is taking a much clearer hit, though, trailing significantly at down 0.4%. And looking at the Dow, well, it's effectively flat. It's just sitting there.
And just like that, the vibe shift is official. We are seeing a hard, undeniable pivot from growth to value. It is Friday, February 6, 2026, and the mood has completely changed.
It really has. I mean, looking at the screens this morning, it feels like we have to start with the primary catalyst because it is ugly out there in big tech land.
Oh, yeah.
We are talking about what everyone is calling the big tech capex nightmare. Amazon dropped a bombshell of a forecast.
They did. And this is the show me the money moment we've been warning about for, what, the last 6 months? The market psychology has snapped. Amazon put out a $200 billion spending forecast for 2026.
$200 billion. That is a staggering number. I mean, just for context, that's roughly the GDP of Greece. They're spending an entire nation's economic output.
Exactly. And investors are looking at that number, and they aren't seeing a cathedral being built anymore. For a long time, the benefit of the doubt was there. Build it, and they will come. But now
Now they're scared.
they're terrified. Big tech is just standing in the backyard, digging a $200 billion hole in the ground.
It's the scale of it that's hard to wrap your head around. But here is the kicker. The variable that makes today, specifically the specific Friday, so treacherous. We are missing the most critical data point on the calendar.
The NFP.
The January non-farm payrolls report was supposed to drop this morning.
Right. And it's gone, postponed to next Wednesday, February 11th, because of the federal government shutdown we just went through.
So let's set the scene. You have Amazon torching the sentiment on one side with this massive spending bill, and on the other side,
We are flying blind.
Yeah.
Completely blind on labor data. This is dangerous because the market is stuck in what we call a liquidity trap without its North Star. The NFP tells us if the economy is hot or cold. It tells the Fed what to do. Without it, there is no conviction today.
there's only reaction. Only reaction.
I want to dig into that concept of a liquidity trap for a second, because usually when we hear that, we think of central banks. But you're talking about market behavior here.
Right. In this context, think of it like driving in a thick fog. When you can't see the road, which is the jobs data, you lift your foot off the gas. Buyers step away. Liquidity it dries up. And when liquidity dries up, price movements get exaggerated. A small sell order moves the market way more than it should because there's nobody there to absorb it.
So the cushion is gone.
Exactly. The shock absorbers are missing.
And the reaction is violent. Let's get into the specifics because the pre-market movers are painting a very, very specific picture. We have to start with the elephant in the room, Amazon, ticker AMVN.
The damage is expensive.
I'm looking at a drop of roughly 8% to 11% in the pre-market.
Yeah.
But here's the thing that might confuse people. The company posted record revenue. They made more money than ever.
Yet the street is completely ignoring the top line and fixating entirely on that infrastructure spend. Why does the spending matter more than the earning right now?
Because the narrative has changed. You have to understand, for the last 3 years, the narrative was growth at any cost. It was simple. If you spent money on AI, your stock went up.
It was an arms race.
Investors cheered the spending because it meant you were in the race. If you weren't spending, you were losing.
Right.
Precisely. But today, the market is revolting against that guide. They are sitting down with their calculators, doing the math on margins, and realizing that a $200 billion spend threatens the very profitability that supports the valuation.
It's capex versus margin.
It's capital expenditure versus operating margin. If your capex explodes, your free cash flow, the money you actually get to keep, implodes.
So it's a margin crush. They worry that for every dollar Amazon brings in, they're spending $2 to keep the AI lights on.
That's it. The growth at any cost era just hit a brick wall.
Okay, so if I'm holding AMZN, or if I'm looking at the chart this morning, I'm sweating. What are the levels? Where does the bleeding stop?
Well, the bulls are in a very tough spot here. To salvage this, AMZN needs a reclaim of $212. That was the support level before the drop.
Okay,
If the price can't climb back above $212, the thesis is broken for the short term. That indicates that the previous buyers are now trapped sellers.
And the downside, if people start hitting the sell button at the open.
The bear case is watching the psychological floor at $200 flat. Round numbers matter. People put their stop losses there.
Right.
If that breaches, and here's where it gets dangerous. If we lose $198.50, that triggers a flush straight down to the 200-day moving average.
The 200-day, that's usually where the algorithmic traders or robots kick in.
Exactly. That is where the algos take over, and they don't care about the news. They only care about the trend. So $198.50 is the trapdoor. If that opens, you do not want to be standing on it.
But here's what is fascinating about this morning, and this is why you can't just say tech is dead. It's not a universal sell-off.
No, it's a rotation.
It's a rotation. Look at NVIDIA, ticker NVDA.
Completely different story.
It's up about 3.3% pre-market. So Amazon, the buyer of chips, is down. NVIDIA, the seller of chips, is up.
This is a classic capital rotation. Money is moving out of software, the SaaS companies, the platforms like Amazon that have to spend the money, and it's moving into the hardware. It's moving into the chips.
It's the old gold rush analogy.
Precisely. NVDA is selling the shovels for Amazon's $200 billion hole. Even if Amazon fails to make a profit on that hole, they still had to buy the shovel from NVIDIA.
NVIDIA gets paid regardless.
They get paid regardless of whether Amazon's AI works or not.
So NVIDIA is acting as the safe haven.
In the tech world, yes. It is the flight to quality within the sector.
So if I'm looking at NVDA thinking this is where the safety is, what levels confirm that I'm right?
It needs to clear $185 for a breakout. If it gets over $185, this hardware rotation is confirmed as real. However, you have to watch your back. Support is at $170. If it fails at $170, it means the trade is too crowded and even the safe havens are getting liquidated.
That's a good point. Sometimes everyone rushes to the same life raft and sinks it. Now we have one more outlier in the tech space that is defying gravity. Palantir, ticker PLTR.
Right.
It's up 5.4% and the volume is high.
Palantir is interesting because it is effectively separating itself from the struggling software pack.
Yeah.
The catalyst here is specific news. A major AI modernization partnership with Cognizant, ticker CTSH.
Why does that matter so much today? We see partnerships all the time.
Because today, the market is skeptical of theoretical AI. This partnership is tangible. It's a real contract with a real company to do real work. It validates their commercial application.
Got it.
Plus, you still have that S&P 500 inclusion premium sticking to the stock.
All right. The index funds are forced to buy it because it entered the S&P. It creates a natural floor.
Exactly. It creates a floor that other software names just don't have.
What are the targets there?
The target is $145. That's all-time highs. Support is sitting at $128.50. But a warning, if the broader software route gets too ugly, watch that $128.50 level.
If it breaks.
If it breaks, Palantir gets dragged down with the rest of them.
Now, let's step outside of tech for a second. We talk about sentiment, but sometimes you just have to look at what people are buying when they are scared. I'm looking at a chart of Bitcoin versus Hershey.
Risk-off indicators. I love this comparison.
Bitcoin is getting absolutely pummeled, down 13% to $64,000. That is the lowest level since 2024.
Wow.
But Hershey ticker HSY is up 8%.
That tells you everything you need to know about the mood. This is a violent rotation into quality and defense.
Yeah.
When people are truly scared, they don't want digital currency. They want chocolate and cash. They want staples.
So crypto is the hit the eject button trade?
It is the first thing to go. It's the highest beta, highest risk asset. Seeing it down 13% while consumer staples bid up confirms that investors are hunkering down. They are preparing for a storm.
Let's zoom out to the macro overlay. We mentioned the NFP delay, which is the missing data, but we still have yield movement. The 10-year Treasury yield is ticking up. We are at 4.21%.
And that is the invisible hand-crushing tech today.
The U.S. dollar index, the DXY, is grinding higher at 97.85. And we also had Fed Governor Lisa Cook on the wires.
She was hawkish. She explicitly mentioned upside inflation risks. When you combine hawkish Fed rhetoric with a 10-year yield pushing past 4.20%, you have a massive headwind for the Nasdaq.
I want to pause on this because we use these terms a lot. Can you just unpack that relationship for the listener who might be seeing good revenue but falling stock prices? Why does a 4.2% yield hurt Amazon?
It's about the present value of future earnings. Think of it this way. Tech stocks are long-duration assets. Their value isn't based on the cash they have in the bank today. It's based on the money they promise to make 5 or 10 years from now.
Okay, so I'm buying a promise of future cash.
Exactly. Now, when yields go up, when the interest rate you can get on a safe government bond goes up, the discount rate goes up. It's a math equation.
Right.
If I can get 4.2% risk-free right now, that money Amazon might make in 2031 becomes worth a lot less to me today.
So the higher the safe rate, the less valuable the risky future looks?
Mathematically, yes. Higher yields literally crush the math that justifies Amazon's valuation.
And there is a specific trap forming here for the retail crowd, isn't there? What we call the pain trade.
This is what worries me for the listener at home. This is what the retail investor is likely missing this morning. They see Amazon down 10%, they see the Nasdaq down, and their instinct is buy the dip. to think it's a sale.
It's muscle memory at this point. Stocks only go up, right?
Right. They are betting on a reversal. But the institutional side sees it differently.
How so?
The institutional side is looking at that 10-year yield. If the 10-year holds above 4.200%, and remember, we have no jobs data to cool it off, the pain trade isn't a bounce.
It's lower.
It's a forced liquidation.
Forced liquidation. That sounds ominous.
It is. It's about margin. If you are a big fund leveraging up to buy tech stocks, and the value of those stocks drops while the cost of borrowing, the yield goes up, you get a margin call. You have to sell. You don't have choice.
So the selling begets more selling.
Exactly. The pain trade is lower, not higher. The market moves in the direction that causes the most pain to the most people. Right now, most people are long tech, so the pain is down.
So if we aren't buying the dip in tech, where is the money hiding? You mentioned Hershey, but looking at the broad sectors, where's the smart money going?
Healthcare, the XLV ETF. It is the strongest pre-market sector, up 11% on the month.
Specifically, I'm seeing strength in managed care.
Managed care and aerospace defense. Those are the two pockets.
Why not banks? Why not energy?
Inelastic demand. Recession fears are starting to percolate. We saw layoffs at UPS. We know Amazon is cutting. So money chases things people need.
You can delay buying a new iPhone.
And you can delay buying a new iPhone. You can't delay heart surgery. And you certainly can't delay national defense.
Yeah.
The mantra for today is simple. If you aren't building a data center or saving lives, the market doesn't want to own you.
Data centers are saving lives. That is a stark way to put it.
It's a stark market.
Okay, let's get tactical. We need to set the levels for the session. If you are active today, sitting at your terminal, these are the lines in the sand. Let's start with the S&P 500, the ES futures.
The line in the band is 6,800.
And the read there.
The index is oscillating. Without the jobs data, it is a trader's graveyard. It's choppy, it's directionless, it's designed to chop you up and spit you out.
So where is the ceiling? Where do the sellers step in?
Resistance is at 6,835. If we fail there, it confirms the liquidity trap. We likely roll over.
And the floor?
Support is at 6,765. That's the breakout point. If we lose 6,765, the bottom falls out.
You mentioned a trap earlier regarding high-frequency traders. This is something people get caught in all the time.
Yes. Prediction for the morning session. HFTs will likely drive the price up to 6,820. They want to lure in the breakout buyers. They want you to think, here comes the recovery.
And once the retail liquidity is there?
They reverse it. Do not get baited into a breakout at 6,820. It's a fake out.
Got it. Now, the Nasdaq 100, the NQ, where's the line?
24,550.
And the character of the market here?
It's a churn zone. Tech is underperforming because of that unproductive AI spending narrative we discussed. It's heavy.
Where are the sellers camped out?
Major supply zone at 24,680. There are institutional sellers camped out there waiting to unload their bags. If price gets there, expect a rejection.
And structural support?
24,420. If we lose 24,420, we are looking at a much deeper correction.
What's the strategy for the NQ today then? Do we short? Do we buy?
Avoid chasing the mid-range. If it gets to 24,650, look for exhaustion.
Yeah.
That's your spot to play the mean reversion back down. Don't try to be a hero in the middle. The middle is where you lose money.
Let's pull this all together for the outro. We have a delayed jobs report, a capex crisis in big tech, and yields creeping up. It feels like we were waiting for the other shoe to drop.
It is a perfect storm for a liquidity trap.
Yep.
The reality is, the real fireworks won't happen today. They won't happen until next Wednesday, February 11th, when that delayed labor data finally hits the tape.
So today is about survival.
Today's about capital preservation. Don't blow up your account on a choppy Friday before the real data drops. Live to trade another day.
We should mention the one safety net we do have, geopolitics. Usually that causes fear, but today it's helping.
Right. The talks in Oman between Washington and Tehran. They are keeping a lid on oil prices. That is providing a geopolitical floor. If those talks fall apart, oil spikes, and this equity sell-off gets much worse. But for now, that floor is holding.
I want to leave the listener with a thought to chew on over the weekend. We talked about the Amazon spend.
It's the paradox of 2026. We just saw January job cuts hit a 17-year high, 108,000 jobs, gone in a single month. Yet, in the same breath, Amazon is forecasting spending the GDP of a small nation on AI infrastructure.
It really begs the question.
Are we witnessing the peak of the AI growth narrative and the start of the AI cost reality? Are we sacrificing the labor market to build data centers that haven't proven their ROI yet? That is the question the market is struggling to answer.
And until it answers it, volatility is the only guarantee. Don't chase the morning bounce. Tighten your stops. The bell rings in 30 minutes.